Hi everyone, welcome. Today we are going to start with accounting standards, which is our lesson number 10. Okay, it is the last three theory chapters of CMA part A. Now, what is accounting standards? It is important for us as company secretaries to know the accounting standards also. Why? Because when we read the financial statements, okay, when we read the director's report, we read the auditor's report, it is always mentioned an opinion which is being given by them that it was prepared as per the accounting standards set. So if we will not know the basics of accounting standard, the purpose of we understanding the financial statements gets defeated. Now all that what we were doing, like how we have Company Act, we have certain sections, we have certain provisions, and attached to those we have the rules. Same thing, accounting is what we are doing, but we have to have certain rules. No? So standards give us some guidance. They kind of lay down the rules for us to understand how to move ahead in accounting that particular transaction or making a financial statements. Like how we did in cash flow statement, I told you there was nothing which is given as a format by the accounting authorities or any kind of act which is saying that this has to be the format of cash flow statement. But with the help of the rules which are given in the accounting standards, we are able to understand that what the cash flow statement would look like. Okay, so accounting standards, the first most important thing about it is that it is the written policy document. Written policy document. Policy of what? Of accounting transactions, of accounting related concepts, giving us the guidance about how to move about doing that particular transaction in the form of accounting language. So it is a policy document giving all the rules, all the methods, all the guidance, okay, all the policies and procedures of a given particular item which appears in our balance sheets and P&L and etc. So it is issued by, who has issued this? Who are the one to make the policy? It is issued by ICAI, Institute of Chartered Accountants of India. Now ICAI is a government authority. It is a government body, a government authority. It is an expert regulatory authority, expert into accounting, right? Similarly, like this is here we have central government. They will issue the accounting standards with the help of ICAI. So ICAI is the government authority falling under the central government, who issues accounting standard which is followed by the companies, and it is given under a Company Act 2013. Similarly, there are also other types of companies which fall under other regulating authorities like Insurance and Regulation Development Authority. Then we have RBI. So for those, they are also the ones who set the standards, accounting standards for those organizations which fall under their domain. Okay. So what are we looking at? We are looking at Company Act 2013. Okay, we are looking at all the accounting standards which are being made applicable for the companies. Now, I will take you all to the theory also, but if we will understand this little basic, it becomes very easy. Now, what does the accounting standard deal with? So, it first deals with the recognition. It also deals with the presentation. It deals with the measurement. And it deals with the disclosure. Of what? What do you think? It will deal with the recognition, measurement, presentation and disclosure of accounting transactions. Of accounting transactions. That is how we know, no? When to debit, when to credit, what is an asset, what is a liability, what should be the treatment of debtors, what should be the treatment of stock, okay, what is P&L appropriation, how it should be treated, depreciation, Okay, what are the methods of depreciation, etc., etc. So accounting standard deals with these 4 things: recognition, measurement, presentation, disclosure of accounting transactions. So to whom is this accounting standards applicable to? Applicable to. What do you think? To whom it is applicable? It is applicable to all. If you go to see, it is applicable to a sole proprietorship firm. Even they will be preparing accounts. Whoever prepares accounts, accounting standards. Partnership firm. Yes. Then we have partnership firm. Then we have societies. Then we have HUFs. After that, say we have body of individuals, association of persons. Then we also have companies, corporates. Then we have LLPs, limited liability partnership. In societies, we have cooperative societies also, etc. Okay. So it is applicable to all of them. Right. For companies, it is compulsory under the Companies Act. It has to be as per a given section. But accounting standards, all these people make the financials. Okay. So they are applicable to our general purpose financial statements. General purpose financial statements. Whoever makes this general purpose financial statements, they have to make it as per the accounting standards. Now, what is general purpose financial statements? Any idea? What are general purpose?
For everybody to refer.
But which financial statement is a general purpose? Everybody to refer. Very good. Who refer? What do everybody refer to the most? If I give you a company's financial statement.
Balance sheet.
Perfect. Balance sheet and P&L. Profit and loss statement. So any organization, any type of organization preparing this general purpose financial statements will definitely see to it that they are doing it as per the accounting standards, and accounting standards are nothing difficult to follow. They are very simple. Okay. So basically this is what we look at. Now, how are these standards set? Okay, setting of the standards. So I am on point number 4. Okay, standard setting process. First thing, okay, first is to determine the areas where a given standard is required. So determine the areas where a standard needs to be put. Standard means benchmarking, putting a process, having a policy for that particular area. Okay, which particular thing requires a standard to be set up. To determine that, after that, what happens is there is a study group, expert study group, who basically assists, okay, the accounting standard board. They are the one to assist the accounting standard board. Now, what do this study group do? They prepare a draft. Okay, draft made by study group. So, once an area is determined, say they are talking about property and plant. Okay, they want some standard based on this particular area. So, the study group will assist the accounting standard board. They will try to analyze what are the basic possibilities applicable across India, which will make this particular disclosure of this particular transaction in such a manner that it will be adhering to the compliances. Also, it will make comparison across in India as well as in the global nation. It will make it possible for anybody to understand. Okay, so the draft made by the study group is presented to the ASB. So what will the ASB do? They will consider the draft. Consideration of the draft by ASB. Now what will ASB do keeping this draft with them? Okay, so what they do is they circulate it. They circulate the draft to ICAI to understand whether they are accepting what is written in the draft. Okay, because it is the government authority, regulating authority for the purpose of everything related to accounts. Okay, so they are the supreme authority in that case. Okay, government regulating authority. So they circulate the draft to ICAI, and after that they keep a meeting. So basically it is a meeting of ASB's study group and ICAI to understand the draft. Once the meeting is conducted, they welcome all the comments from the ICAI council, ICL members or the council members. Okay. After the comments are done, when you receive any comments, obviously those comments, any changes should be incorporated in the draft. So from there, okay, there is a submission of final draft. After the comments are incorporated, submission of final draft is done by ASB to ICAI. Again, same thing. There will be consideration of this final draft. This is the final draft. Okay. Fine. After comments are incorporated. Final draft by ICAI, council members. And once the consideration is done, the last step is the standards are issued. Simple. Now this is like they have given us in theory form, okay, which is really boring to go ahead and read. But if you just understand as to what is the process, we all have now come to know, okay, there is a study group, they make a draft, give it to ASB, ASB forwards to ICAI, ICAI gives comments, submission of final draft then done by ASB, and standards are issued if everything is going well, right? Okay. So this is the standard setting process. Next is now accounting standard under now this section 143 subsection 3E, okay, of Company Act 2013. It states that the auditor of the company has to give in his opinion, as an opinion, whether the financial statements of this company are prepared as per the accounting standards. Again, it is important for the auditor to know all the accounting standards. This opinion matters a lot. He has to give this. It is written in section 143 subsection E. Next is board report. Okay, as per section 134 subsection 5A, director's responsibility report. This is also one report, okay, one part of the financial annual statements which are being circulated to the members. Director's responsibility report also should state, board of directors should state that all their accounts are prepared as per the accounting standards. Policy is given as per the accounting standards. Cool? Next is advantages. Now this advantages you all will tell me. What do you think are the advantages of accounting standards? What is the advantage? If we will not have accounting standards, what could not happen? Like
uniformity.
Very good. Uniformity. Uniformity across all the organizations, no? Uniformity across all the financial statements, I will say. Right? When you get uniformity, What increases? Reliability. Reliability of financial statements will increase. Uniformity of financial statements. Then next, when reliability increases, credibility will also increase. People will trust. Okay, so once people start trusting, this company will start gaining some credit. Then benefits of comparison. It also benefits the governments, auditors, right or no? Additional disclosures which are required, which otherwise companies would not do, but due to the accounting standards they are following it and disclosing it. Okay, it gives reform. It reforms the accounting theory, accounts theory. So if these are the advantages, we all talking about like accounting standards is important. So can accounting standards have any disadvantage? Disadvantages. Tell me. What could be a disadvantage?
A lot of rigidity.
Oh yes, there is a lot of rigidity. Advantages of accounting standards: rigidness, I can say. People do not want to follow. There are some difficult choices. There is, sometimes it is also difficult to measure as per the accounting standards. Okay, so the measurement, mechanical way of following. So the rules are given, but it's not very clear for everybody to understand. Okay, mechanical choice. Also, there are a lot of discrepancies sometimes between the act and the accounting standards. So now what to do? Whom should we follow? The act or the standard?
And by principle of law, the act, because the act is the...
Yes. So if there is any discrepancy, or if there is any kind of, what will prevail? Always whatever is given in the act will prevail. We cannot say accounting standards is correct. If there is a dispute, okay, accounting standard is saying something else about stock, act is saying something else about the stock. What will prevail? Whatever is written in the act will prevail. Okay. So as of now, I think we have some, actually there are total 32 accounting standards which are issued. But at present we have only 27 accounting standards which we have to look after. In that also, like how this is 27, because 30, 31 and 32 are withdrawn already. Also there was an accounting standard 6 and 8 which is also withdrawn and replaced, okay, by 7 and 10. It is something like that. So we are supposed to know 27 accounting standards. Now if you tell me that ma'am, we should know which accounting standard belongs to which item of the balance sheet P&L, yes, you have to know it. Because in the MCQ, this is what they are asking. They will not ask you the treatment given in the accounting standard of a given inventory or cash flow statement. We have already done that. Okay, but they will ask you which accounting standard belongs to what. They will tell you accounting standard for earning per share. What is it? They will ask you accounting standard for construction cost, cash flow statement. Okay, so yes, you have to know all the 27 accounting standards, right? Some of them you will be able to easily remember it. We had done in that financial statements interpretation also. Related party disclosures, inventory, all that we have done. So some, if you will keep now, so you can't sit and mug it up. But if you will keep reading and looking at those standards again and again, Yes, you will be able to remember it when it is asked in the MCQs. Clear? Now coming to one of the important part. Okay, applicability. I told you it is applicable to all, but applicability of accounting standards given as per the Act. What is there? Okay, so there are entities, all the entities I gave you all, so sole proprietorship firm, etc., etc. Now in the entities we have corporates, and there are some which are in non-corporates form. Non-corporate. Now non-corporates we have divided in 3 levels. Okay, there is level 1, 2 and 3. We will have to see which accounting standard is applicable to level 1, level 2 and level 3, because there are certain exemptions given, partial and complete exemptions which are given to them. Okay, exemptions, because they are non-corporates. Okay, for corporates, yes, accounting standards, obviously it is applicable to all the corporates, but in the corporates we have divided again. There can be SMCs, small and medium corporates, and non-SMC. Okay, so if it is a non-SMCs, there is no exemption. All the accounting standards are applicable. Okay, all the accounting standards are applicable. But if it is an SMC, then they have given us some partial exemption. Okay, we will see that in the theory also. Partial exemption with respect to accounting standards, I think so. It is 17, 15, accounting standard 19, 20 and 29. And there is a complete exemption of our favorite accounting full exemption, accounting standard 3. Which is it? Accounting standard 3.
Cash flow.
Yes. So complete exemption from accounting standard 3. So if it is an SMC, then we'll have to take care that it is 15, 17, 19, 20 and 29 partial exemptions are there. Okay, and complete exemption for accounting standard 3. But what are SMCs? So they have defined them. They are saying SMCs will be the ones whose equity, first condition, equity or in that case debt is not listed, or they are not even in the process of getting themselves listed. Okay, next, it is not a bank or not a financial institution or not an NBFC, or not an insurance company. Okay, insurance company. Third, they are saying their turnover does not exceed 250 crores. Fourth is their borrowing does not exceed 50 crores. And the last is that they are not a holding company, not holding or a subsidiary company of a non-SMC. Because if they are holding or a subsidiary company of a non-SMC, they will deem to become a non-SMC. So for non-SMC, so all the standards are applicable. We don't have to see anything. What we have to see is for SMCs, what is exempted. Complete exemption is only AS3. Partial exemption, how does it work? And then for non-corporates, we have to see all level wise. Okay. Now, in between, I think somebody was asking me what is Indian accounting standards. So, we have 2 sets of accounting standards. One is AS and one is IAS. Okay, now why we have to do this IAS? IAS is applicable to certain specified entities. Okay, specified companies only. We will see that in the next chapter. but specified companies, they have to follow IAS, Indian Accounting Standards. Okay, accounting standards, two sets are there, AS and IAS. To whom IAS has to be followed, there are those companies which are being specified by, and it is being specified by MCA, Government of India, okay, in association with IFRS. Okay, that we will see in the next lesson. So as of now, just know that we have to follow these two standards, these two set of the standards. But accounting standards, all the accounting standards, we will be doing one at a time. Okay, and we will also understand why we need to have this IFRS in place and why certain specified companies have to follow IAS instead of AS. Okay, clear brief outline overview of this chapter. Rest all is theory, history. Okay, I'll move to the theory part. The ones which I have already explained you all, I'm just quickly going to go ahead with the markings, right? So meaning of accounting standards, first is accounting, two words, accounting and standards. Okay, so we have already known what is the meaning of accounting. So standards, we mean the model. Okay, any deal, a model, therefore it is an acceptable model and ideal for accounting. Okay, now what are they? They are written policy documents. They provide us, they are provided by ICAI. It is a government expert body. Okay, it deals with recognition, measurement, presentation and disclosure of the transactions and the other events. Okay, so recognition of the transaction, measurement of the transactions, they have given you all certain examples, measurement, presentation of the transactions, and then the disclosure of those transactions and other events. Okay, you all can read through the, you don't have to sit and learn everything given inside what is written. Okay, but you all have to know the outline, brief. So I can in short say that it is defined as a written policy document issued by an expert accounting body or government or other regulatory bodies in aspect of recognition, measurement, presentation and disclosure. This is what is important. In nutshell, this is what we are doing, right? Now applicability of accounting standards. Okay, statements of accounting standards. Accounting is issued by ICAI. This is what you need to know. They intend to apply to all the enterprises. So in short, it applies to sole proprietorship firm, partnership, society, trust, HUF, AOP, BOI, body of individuals, cooperative societies, companies and LLPs, right? Now they are applicable to general purpose financial statements, which includes balance sheet statement and profit and loss statement and cash flow statement as and where applicable, and explanatory notes, which are read by various stakeholders, governments, their agencies and public at large. It is available for public at large. Standard setting process. See, this is what I had explained. Determination of the board areas where the standard needs to be formulated. Assistance to the ASB by the study group. Presentation of a preliminary draft of this accounting standard by the study group. So basically what all it will include when they will prepare this draft, they will give the objective, the scope of the standard, definition of certain terms they are using, recognition and measurement principles, and presentation and disclosure requirements. Okay. Step 4, considering this preliminary draft by ASB, circulation of the draft to the members of ICAI and specified other bodies in that case, meeting of ASB with the representatives of the body to finalize the draft. Step 7, issue of exposure draft or comments by the members and the publics of the specified bodies. Okay, so if there are any comments, they are all accepted. Those comments are then included, changes in the draft are done, and submission of final draft to the Council of ICAI. and consideration of the draft by the council and issue of the standard by ICAI. Okay, so these are standard, these are the steps for setting up a standard. Alright, they can ask you in the form of MCQ, the hierarchy. What comes first? Accounting standards and auditors as per section 143 subsection 3 subsection E of Company Act requires the auditor to report in his opinion whether the financial statement comply with the standards referred under section 133 of the Company Act. Also, director's responsibility statement as per section 134 subsection 5A of Company Act should also include that the presentation of the annual accounts, applicable accounting standards have been followed. Fine. Advantages of accounting standard. Okay, now general advantage, it describes the accounting policies, valuation techniques and methods of applying these accounting principles when you prepare the financial statements. Therefore, it will give us a true and fair view of the financial position. This is the general, this is the base, this is a vision and mission of accounting standard to give a true and fair view of the financial performance of the enterprise. But apart from that, there are various advantages. It improves the credibility and reliability. Why? Because it brings on uniformity. Comparability is made easy. Benefits to the accountants and the auditors. Additional disclosures is possible. Evaluation of managerial ability. Okay, management reporting profitability, liquidity statement, ratio statements, etc. It becomes very easy if the accounting standards are already in its place with its rules and regulations. Helpful to the government reforms in the accounting theory. However, the disadvantage is difficult choice, mechanical choice, and not different from law. Okay, so accounting standards cannot override the law. So conclusion, advantages are more than disadvantages. Obviously, we have to follow the accounting standards, right? Now, in assessing whether an accounting standard is applicable, one must find the correct answer to the following three questions. Does it apply to the enterprise concerned? If yes, then the next question. Does it apply to the financial statement? If yes, next question. Does it apply to the financial item concerned? These three things. Whether it applies to that enterprise? If yes. Whether it applies to the statement? Yes. Then whether it applies to that financial item. Okay. There are 27 accounting standards. 32 were issued previously, but right now 27 are the accounting standards which are available, applicable to the companies. Okay. So each one is given here. I have given later on in the chapter, we have given the brief understanding of each and every standard. Okay, so you all can read that. But what is important for you all to remember is this. Accounting standard 1, disclosure of accounting policies, valuation of inventory is AS2. Cash flow statement we have by now we all know. Contingencies and events occurring after the balance sheet date, net profit or loss for the period, prior period items, changes in accounting policies if in case you have done, construction contracts. Accounting standard 9 is revenue recognition, 10 is again revised, property, plant and equipment. So you will not find anything like depreciation now. Earlier there was one accounting standard of depreciation in place of this AS 10. But now it is property, plant and equipment. In that only they have given the rules relating to depreciation. Okay. So effects in foreign exchange currency rates, government grants, accounting for investment, accounting for amalgamations, employee benefit. AS 13 is the borrowing cost. Segment reporting we have done, related party. Earning per share is 20. This is their favorite, they ask. Lease is 19. Consolidated financial statement 21. Accounting standard 22. Taxes 23 investments in associates, 24 is discontinuing of operations, interim financial reporting 25, intangible assets 26, joint ventures, impairment of assets, and last is provisions, contingent liabilities and contingent assets. Okay, applicability of accounting standards. Now this is what we will look in detail. Okay, I have given you all this chart already. Corporate, non-corporate. In non-corporate there are 3 levels: corporate, SMCs and non-SMCs. Let's read what is there. Okay, classification of entities in detail. For the purpose of applicability of accounting standards, companies are categorized as follows. SMCs, they are those who will fulfill the following conditions: equity and debt securities are not listed, and they are not even in the process of getting listed in India or outside India. It is not a bank or a financial institution or an insurance company. The turnover excluding other income does not exceed rupees, okay, it is rupees 50 crores immediately. One second, it was 250 crores. I will just recheck this again. Companies does not have a borrowing exceeding rupees 10 crores at any time during the immediately preceding accounting year. Okay, because accounting year for every company sometimes keep changing, Jan to December, April to March. So we will see the accounting year. Company is not a holding company or a subsidiary company of a non-AMC. Okay. Partial exemptions, I told you, partial exemptions, certain exemptions are given partially. Accounting standard 17, which is segment reporting. AS is employee benefit. 19 lease. 20 and 29. To whom? To SMCs. Full exemption is given for the purpose of accounting standard 3. Cash flow statement shall not apply to SMCs, one-person company and dormant company. For non-SMCs, all the accounting standards are applicable. Simple. Okay. Now, what are non-corporate entities? They are those entities which are other than the companies. So, it can be one cooperative societies and charitable entity. Okay, if they carry on any commercial, industrial or business activities, even if it is in the small portion, then in such case, accounting standard will be applicable to its entire activity. Partnership firms and sole proprietorship firms, society registered under Society Registration Act, HUF and AOP, Association of Persons. Okay. Non-corporate entities are not under any obligatory requirement, not compulsory, okay, to follow the accounting standard. But if such entities are required to get its financial statement attested, audited, okay, it will be the duty of the member of ICAI, because obviously auditor will come from ICAI, to examine whether these standards have been complied with. So in short, if audit is compulsory for this particular non-corporate entity, you have to follow accounting standards, because you have to get an audit done. If audit is to be compulsory, auditor is going to come, auditor is going to give an opinion. In that case, yes, your accounting standard becomes compulsory. Okay. Okay, in case of entities, okay, SMC entities, it is 50 crores and 10 crores. Alright. Now somebody is asking me that they are not understanding this point of borrowing, etc. If in order to know that whether a company is a small and medium corporate entity, they have given me this 5 particular details, okay, and they are saying if all these 5 conditions are satisfied, only then it will be an SMC, otherwise it will not be an SMC. Now what does this mean? Turnover does not exceed 50 crore. Turnover means revenue, their sales, okay, whatever business they are doing, their operations does not exceed rupees 50 crore. And their borrowing, they must be taking some borrowing, public deposits, borrowing, etc. does not exceed 10 crores. Okay. So in order to be a non-SMC, first thing you have to not be listed. You are not a bank, you are not a financial institution, you are not an insurance company. Turnover and borrowing criteria is also given. And if you are a holding and subsidiary of a non-AMC, you deem to become a non-AMC. Okay, so then you will not get any partial exemption, you will not get any complete exemption from accounting standards. Everything will be applicable. Okay, so come back to this part of entities here. So what I have given is correct. Here, all the 5 conditions A, B, C, D and E. Okay, 50 crores does not exceed, excluding other income, does not exceed 50 crores. That means they're talking about their operating turnover, and does not have borrowing exceeding rupees 10 crores, means it has to be max 10 crores at any time, including the public deposits, if any, of that accounting year. Okay, clear? The doubt, whoever had this doubt. Now we need to know what is level 1, level 2 and level 3. Okay, so we will read level 1 first. Okay. What are level 1 entities? Those conditions are given. Entities whose equity or debt instruments are listed or are in the process of getting them listed in India or outside India. Banks, including cooperative banks, financial institutions or entities carrying on insurance business. Okay. All commercial, industrial or business reporting activities having borrowings which is not going to be borrowings which is more than 10 crores at any time during the immediate accounting period, turnover which is more than 50 crores during the immediate preceding accounting period, holding or subsidiary of the entities of any of the above. It is just totally the opposite of what we read in SMCs. So this you will be able to remember in level 1. So which are the accounting standards applicable to them? All except accounting standard 21, 23 and 27 will apply based on the regulatory requirement, if any. Otherwise it is not compulsory. 21, 23 and 27. Want to go back and read what is 21, 23, 27? Let's see. It is there in our list. Okay. So consolidated financial statements is 21. 23 is accounting for investments in associates. And 27 is joint ventures. So it is basically holding, subsidiary, associate and joint ventures. It will be easy for you all to remember like this only. Getting my point? Okay. Level 1 understood? It is opposite of SMCs. Now going to level 2. Now why am I doing so much of time on this? Because they are asking all this in the MCQs. And you will have to remember it. Now level 2, other than level entities, if they fall under the following limit, all commercial means all the other 2 limits are the same. Okay, entities whose equity debt instruments are listed or in process of getting listed, banks including cooperative, financial institution entities, etc. But they're commercial transactions reporting, having borrowings, okay, which is not to exceed 1 crores at any time during the accounting year, and turnover not exceeding 10 crores. Okay, so here the borrowing and the turnover changes. This is totally opposite of the SMC. This is little different. In case of commercial activity reporting, 1 crore in case of borrowings not exceeding 1 crore and not exceeding 10 crores. Full applicable accounting standards are applicable except again level 21, 23, 25, 27 and those discussed below. So there is certain relaxation, partial relaxation. Lease, earning per share, okay. Then 29, provision, contingent liabilities and contingent assets. Accounting standard 3 is totally not applicable. Accounting standard 17 is totally not applicable. This is full exemption. This is partial. All the accounting standards are applicable, okay, to level 2 entities except accounting standard 21, 23, 25, 27. If it is relating to that particular, there is some regulation authority asking for that standard to be followed, then it is okay. But otherwise, all these are not applicable. Also, there is partial relaxation on accounting standard 19, lease per earning per share and provisions, contingent liabilities and contingent assets. Accounting standard 3 not applicable. 17, segment reporting not applicable. What segment reporting they will do? They are such a small level 2 entity. Borrowing is not exceeding 1 crore, turnover not exceeding 10 crores. Okay. All non-corporate entities other than level 1 and other than, we are not fitting in any of the categories. In addition to partial and full exception given above in level 2, full exemption is also given to them in case of accounting standard 18, which is related party. Disclosures accounting standard 24, discontinuing operations. Okay, so all this is applicable to level 3 also. All this exemptions is applicable to level 3 also. But along with that, plus this is also applicable. They do not have to take any, they don't have to worry about any accounting standard of related party and discontinuing operations. Okay. Clear? Any doubt you all have? You all want to ask any question based on this?
Ma'am, what sort of questions would they ask from this part?
They will ask you from the following accounting standard, which is exempted for level 1, level 2, level 3.
Okay, thank you.
I have taken all the exam questions after the theory. So we will have a look at it. So conclusion, like basically they are saying requirement to follow accounting standards. Corporate entities are required to follow the accounting standards while preparing their financial statements, which are given as per section 129 of Company Act as discussed above. Non-corporate entities are also required to comply if they want to get the accounts attested by CA. This is what we read previously. This is the conclusion. Entities shall comply with accounting standard 25 only if they are required or they voluntarily opt to prepare and present an interim financial report. So if they want to prepare an interim financial report, then you can, all the entities. If you are not preparing only interim financial report, then whether you are a corporate entity, non-corporate, level 1, 2, 3, let it be anything. If you are not preparing only an interim financial report, why will you comply to that standard? So if you are preparing interim financial report, then you will follow the standard given for this. That is AS 25. Okay. So there are two sets of accounting standards, AS 1 to AS 5, then we have AS 7, then we have AS 9 to 929. Okay, and Indian accounting standards, those are there from Indian accounting standards 1 to Indian accounting standards 41, and then from 101 to 116. Okay, they are applicable. Are another set of accounting standard, Indian AIS. Okay, Indian AS are standards notified by the MCA Government of India, which are covered by with the international reporting standards. These accounting standards are formulated again by the Accounting Standards Board of Institute of Chartered Accountants of India, ASB Board of ICAI. Okay. So MCA along with IFRS, they have notified 41 Indian accounting standards as Companies Indian Accounting Standard Rules 2015, given in that amended Rules 2016. Indian accounting standards we will discuss in lesson number 12. Okay. Now accounting standards in brief, I have given you all everything. Okay. So which accounting standard talks about what? So now say if I am talking about disclosure of accounting policies. Accounting policies are the specific accounting principles and the methods for applying those principles adopted by the enterprise in presentation of their financial statement. All the significant policies should be disclosed. Whatever the policy of the company are, they have to disclose in their financial statement as per AS1. Valuation of inventories. Okay, we always take closing stock to our balance sheet. So we have to value them and put it in a financial statement until their revenue is recognized, until they are being sold. Okay, this standard deals with determining that value, ascertaining the cost and write down thereof to net realizable value. I will do 2-3 sums based on this. Okay, cash flow statements, contingencies and events occurring after the balance sheet date. You just closed your balance sheet and now there are events which are occurring. So what has to be done with that? It is all given in AS4. Net profit or net loss, you have any prior period items, changes in the accounting policies if you have done any, then you have to disclose it as per AS5. Construction contracts, when contract revenue and contract cost should be recognized as revenue and as expense, because in construction contract it is very difficult to understand how much should I take it as a revenue, as a turnover in my P&L, how much should I take it as a closing stock. So all the principles and rules are given under this construction contracts AX7. Revenue recognition. Okay, revenue recognition at the time of sale of goods or sale of services. Okay, the use by others of enterprise resources yielding interest, royalties, dividends. AS10, property, plant, equipment. Regarding depreciation also, everything here it is included. Effects of change in the foreign exchange, accounting for government grants and subsidies, accounting for investments, accounting for amalgamations, liability, employee benefits. It's a liability, to an organization. Okay, so whatever a liability when an employee has provided the services, and expense when the enterprise consumes this services, economic benefit arising from this particular services. Borrowing cost, amount of the cost to be capitalized during the period. What should be short term, long term, right? Segment reporting, if there are different products and services of a given enterprise. Related party disclosures, important whenever you are having any related party transaction. Lease, companies not necessarily have everything owned, they can take everything on lease also. Plants, resources, etc. can be on lease. Okay, lease agreements. Earning per share, determining the way of calculating earning per share. Diluted earning per share when there is an increase in the shares capital. Okay, consolidated financial statements, accounting for taxes on the income, investments in associates, discontinuing operations if any, interim financial reporting if you want to remove an interim financial reporting, intangible assets, patents, goodwill, etc., writing them off, amortization, everything here. AS7 27 is financial reporting of interest in joint ventures, impairment of assets. Impairments, what is impairments? The objective of this standard is to prescribe the procedure that an enterprise will apply to ensure that its assets are carried at no more than the recoverable amount. Okay, we keep on carrying the assets now for a long time. So what should be the value of that asset to be carried in the statements? It should not be more than the recoverable net realizable value. That we will do it even in the stock. Okay, provisions, contingent liabilities and contingent assets. Okay, clear? Now what is the need for conversions with the global standards? Our accounting standards are there only, but now I am telling you we also have to look at the standards given by MCA and IFRS. So what is the need? We will just quickly read this. Okay, this is all theoretical, not very important, but for us to know. Each country has its own sets of rules, regulations for accounting and financial reporting. Therefore, when an enterprise decides to raise capital from a market other than their own country, the rules and regulations of that country apply. And in turn, this requires the enterprise to understand the difference between the governing financial reporting foreign country as compared to its own country of origin. Okay, so it is same applicable if any other company wants to come in India and do some business. Again, this problem is going to come. That is why we are trying to come and amalgamate with the global standards and have something in uniformity. Okay. Therefore, translation, reinstatements are of utmost importance. Okay, accounting standards and principles need to robust so that large society develops degree of confidence in the financial statements which are put forward by an organization. International analyst investors would like to compare these financial statements based on the accounting standards. Obviously, the harmonization of financial reporting around the world will help to raise the confidence of the investors also. So today, if an Indian company wants to raise funds or have their shares listed abroad, if the financial statements are improving the credibility and confidence amongst the investors in that country, automatically the business is going to boost. So the convergence of financial reporting and accounting standard is a very valuable process which contributes to free flow of global investment and achieve the benefits for capital market stakeholders. So for that we have a separate board. We have International Accounting Standards Board. Okay, the London based group, it is a London based group, International Accounting Standards Committee. It is responsible for developing international accounting standards. It was established in the year June 1973. Now this is an important date. It is now known as IASB, International Accounting Standard Board. Okay. Now this comprises of professional accountancy body across 75 countries. ICAI is a part of it. So they have different countries who are its members. Even ICAI is a member for this particular International Accounting Standard Committee. Okay. First IASC was established in public interest to formulate and publish international accounting standards to be followed. Okay, in presenting, were issued to promote acceptance and observance of the international accounting standards worldwide. Then in between 73 and 2000, this committee has now released international accounting standards. Then between 1997 and 99, they restructured the organization, which resulted in formation of the board. So these changes came into effect on 1st of April 2001. Subsequently, IASB issued statement about current and future standards, okay, published in a series of pronouncement called IFRS, International Financial Reporting Standards. Okay, so they are known as global standards. Okay, they are the ones which is issued by the committee, International Accounting Standards Committee. Okay, interpretations are issued by the Standard Interpretations Committee and International Financial Reporting Interpretations Committee of IASB. So this board has International Accounting Standard Committee, they have Standards Interpretation Committee, and they have IFRS Interpretation Committee also. Okay, International Financial Reporting Standards comprise of 16 International Financial Reporting Standards, 24 International Accounting Standards IAS standards issued, interpretations issued by the IFRS committee, and 4 interpretations which is issued by SIC committee. Okay, there are some important advantages of IFRS. Okay, what are the important advantages? It would facilitate comparability, obviously, across the globe, across different countries. Financial reporting process becomes more transparent. Standardization of the entire accounting policies, technology, which will provide creditors and investors an ability to analyze the business. It would permit international capital flow more freely. It will give the investors better understanding of the financial statements. It would benefit the accounting professionals as well. So why do we have, this is important now. So we have conversions of IFRS with in India with the global standards. Okay. So recognizing the growing trend for full conversions of Indian accounting standards with IFRS, okay, constituted a task force to examine the issue which is involved. So they were trying to understand that now how to reconcile it, because we already have our accounting standards. Now again having another set is, then we have to reconcile it whether that accounting standard is giving the same policy procedure as per the Indian accounting standard which is issued by IFRS. Okay. While formulating the accounting standards, ICAI recognizes the legal and other countries prevailing in India and make deviations from the corresponding IFRS. Now why IFRS? You can just read it. It is just for the theoretical purpose. Indian GAAP. What is IGAP? IGAP is a set of accounting standards that are specifically designed for keeping India in mind. Okay, Indian context. GAAP stands for Generally Accepted Accounting Principles. Most Indian companies follow this. Okay. When a company follows IFRS, it needs to provide a disclosure in the form of note that it is going to comply with IFRS. But for Indian GAAP, the disclosure of the statement is not mandatory. Okay, so the company can follow IFRS or it can follow IGAP. If they are following IFRS related in accounting standards, they have to give a note about it. For this, it is not compulsory. When a company is said to follow the Indian GAAP, it is assumed they are complying with the Indian GAAP to portray the true and view financial affairs of the company. Now, difference they have given of IFRS and GAAP. What is the difference? First time adoption. First point. Okay, full retrospective application of IFRS to P&L and balance sheet, reconciling P&L balance sheet with last year reported numbers under previous GAAP. No need to prepare reconciliation on first time of adoption. When IFRS first time adopted, it has to be reconciled with the previous year's P&L and balance sheet. If you are doing IGAP, there is no reconciliation required. Components of financial statement, balance sheet, P&L, cash flow, equity and accounting policy, notes to account. This is also same, balance sheet, P&L, cash flow, if applicable, and notes to accounts. Balance sheet, no particular format, a current, non-current presentation is used. Here, when we are doing as per Indian generally accepted accounting principles, we are following Schedule 3. Right now, we are following Schedule 3. Income statement also we are following Schedule 3. Cash flow statement mandatory for all entities. Level 3 entities are exempted from cash flow statements. Dividends, liability to be recognized in the period when dividend is declared. This is an Indian accounting standard 10. Recognized and as appropriation of profit, we remove from a P&L appropriation. And it is recorded as a liability at a balance sheet date even if declared subsequent reporting period but before the approval of the financial statements. Major repair and overhaul expenditure on fixed assets recognized in the carrying amount of the assets. Expense, only expenses which increases that value is to be capitalized. Difference they are giving. Revaluation if you are doing of the assets to be updated periodically so that carrying amount does not differ from the fair value at the end of the period. Revaluation to be done for the entire class of that assets. There is no such specific requirement of revaluation. As and when the organizations want, they can revalue it. Change in the method of the depreciation considered as a change in accounting estimate to be applied prospectively. Considered as a change in accounting policy, retrospective computation and excess deficit and adjustment has to be done in the depreciation. Earning per share disclosure to be made only in consolidated financials of the parent company. Disclosures of earning per share both Consolidated statement, separate financial statement, both it is required. Component accounting required each major part of number such requirement. Profit prior to a PPE, okay, it is a pre-period profit or earning with a cost that significant relation to total cost should be depreciated separately. There is no such requirement of component accounting. Component, we don't have anything like this. Intangible assets can have indefinite useful life, and hence such assets are tested for impairment and not amortized. Here we do amortization. We take 10 years usually. Reporting the currency requires the measurement of profit using functional currency. Entities may however present financial statements in different currency. As per schedule 3, we have to do it as per Indian currency. Key managerial person, it includes executive as well as non-executive directors. Okay, here it does not exclude non-executive directors. It means totally yes, but we have those part-time directors. Part-time directors are also one kind of non-executive directors only. So I do not believe this in this like a difference point. But it's okay, for theory we have to understand it. Compensation, we did know managerial remuneration. Okay, disclosures to be made for total compensation such as short-term employment benefit, post-employment benefits as per IFRS. We do not have any such breakup. Fringe benefits taxes includes as a part related expense, fringe benefit, which gives rise to incurrence of tax. This is disclosed as a separate item after profit before tax on the face of the income statement. Uniform accounting policies may differ due to impracticability. Disclosure of extraordinary items prohibits any such disclosure. No such term in IFRS. Extraordinary items, we disclose it separately. Profit before extraordinary expenses and incomes, extraordinary items. We have 39 IFRS. Okay. 1, 2, yes. See, this is 1. Just make the correction if you all are having a, if in case you all are having a printout. It is from 1 to 41. And this is 101 to 116. Okay. 101 to 116 this is. Hundred and 4, 105, 106, 107. Okay, and the last ones are from 1 to 41. So the IAS, if you will see 1 to 41, no, you will find it a little bit close to our accounting standards. So there are some specified companies who have to follow these IFRS related Indian accounting standards, these 2 sets. Okay. That is it with the lesson number 1. We will just quickly go through the exam questions. I want to take you all to that inventory cost also. Okay. The Accounting Standard Board was constituted by the ICAI in the year 1977. Auditor has to give his opinion whether the accounting standards have been complied with under which section? 143(3)(e). Okay. Which of the following is not included as a conditions to be specified by the satisfied by the SMCs for applicable of accounting standards? Holding a subsidiary of non-AMC, this was a condition. It's not a bank or financial institution or insurance company, this also was a condition. C. Company's turnover does not exceed 10 crores in the immediately preceding accounting year. Any kind of this condition was there? It was 50 crores, no? So this is the right answer. Equity debt are not listed. This was also the condition. Which of the following international accounting standard is relating to earning per share? IAS, International Accounting Standard. Here only the board is. Earning per share, International Accounting Standard 33. Which of the following is a small and medium-sized enterprise as per the company's accounting standard rule 2006? Okay. X Limited has appointed a merchant banker to prepare red herring prospectus for the purpose of filing the same with SEBI. Now, what does this indicate? Are they not doing a listing? They are inviting money. Yes. Y Limited, Y Private Limited, engaged only in the insurance broking business, has a turnover of 55 crores including other income of 5 crores, GST collected of rupees 1 crore, and shown as unsecured loan and secured loan from bank is 9 crores and public deposits of 1 crore. Z Private Limited acquired 51% equity in a listed company. It has a turnover of 50 crore and borrowing of 10 crores. So it has become a holding company. W Private Limited has a turnover of 55 crores including other income of 5 and took secured loan from bank 10 crore, public deposit of 1 crore, which are fully paid before the end of the financial year. What I want to do of the financial year? I am interested in the accounting period. What is the turnover and their borrowing amount? Okay, so out of all this, which is the SMC? This Y Private Limited only. They are not insurance company. They are insurance broking business. Okay, has a turnover of 55 including other income. So if you will remove that 5, it will become 50 crores turnover. Also, the secured unsecured loan is 9 CR and public deposit is 1 CR. 10 borrowing. Okay, here if you see, the borrowing is becoming 11 CR, exceeding 10 crore rupees. These are the type of MCQs they are asking. Okay, now AS3 cash flow statement and AS17. 17 is segment reporting, no? Are not applicable in their entirely to level 2, level 3 SMCs. It is all of the above. You will have to keep reading that chart which I have given you. Okay, in this. Keep reading that chart. You will get an idea. If you all want, make one small note of that again. All of the above. AS13 and AS24 related party transaction and 24, we'll have to see again what is that, are not applicable in their entirely to level 2, entirely, completely. Level 2 entities or level 3 SMCs or all of the above. They have given level 3 entities. We will check AS18 and 24. It is there in my chart only. Level 3 here. AS18 and AS24. Not applicable completely, entirely. Level 3. Okay. Next question. Okay. AS7 issued by ICAI that deals with construction contracts. GAP stands for Generally Accepted Accounting Principles. Right? Okay. Next question. X Limited has 5,000 AC in stock, okay, on 31st of March 2019. The cost of each AC amounts to rupees 10,000. There is a firm commitment of the sale of rupees 10,000 AC by the company in April 2019 at rupees 15,000 per AC. Sale of 10,000, not 10,000, sale of amounts to rupees 10,000. This is cost of each AC is amounting to rupees 10,000. Commitment of sale of 1,000 AC, right here. 1,000 AC by the company. They have a commitment of selling this 1,000 AC and they are going to selling price is going to be rupees 15,000 per AC. However, the general price of this AC at the year end amounts to rupees 9,500 per AC. Now just understand the question once again. Okay, they are saying in the stock on 31st of March, closing stock means they are talking about inventory. There are 5,000 AC. Cost of each AC is rupees 10,000. Every time closing stock we record at the selling price or at the cost? Whenever we take closing stock to our balance sheet, there is a stock which is remaining with us, okay, inventory. So when we record that in our balance sheet, inventory, do we record it at cost or we record at selling price? Have we sold it?
Cost price.
It is always at cost price, no? So for me this cost price is important. Now they have given me this statement. There is a firm commitment of sale, 1,000 AC. They are going to sell it by the company in April 2019. So, but what will I do of that? They are going to sell. They have not yet sold. Just an assumption they are making that they are going to, commitment is there, but yet nothing has, there is no approval of the transaction yet, only commitment is made. So what will I do for that commitment? I can't do anything about that commitment, no? So I will ignore this particular statement. Okay. They are going to sell them at rupees 15,000. Okay. Whenever they will sell, it will come as a turnover. However, the general price of this AC at the year end is amounting to 9,500 rupees per AC. Now, what does this mean? This is the net realizable value. Net realizable value. In case of stock, no, always remember, you record it at the cost price or at net realizable value, whichever is less, as per the standard, inventory standard, whichever is less. Okay, so in my case, if you see how much is the inventory, 5,000 into 9,500. Do it. This is the answer, huh? 475 lakhs. It's as simple as that. They have just given you this 1,000 commitment of AC to be sold at 15,000 just to confuse you. But anytime they are giving you cost as well as they are giving you the net realizable value, always recorded at the net, whichever is the less one, whichever is less. Because it is obvious, no, that at the end of the year, when this particular AC is now reducing in its value 9,500. So when I am recording in the balance sheet, as and when just recorded at the net realizable value. Tomorrow, if I am not able to get 15, I will at least get 9,500, but I will not be able to recover 10. That is the basic logic. Understanding? Okay. AS 11 issued by ICI deals with foreign exchange transaction. This is how they are asking in MCQs. Now see, Ravi Limited purchased goods at a cost of rupees 40 lakhs in October 2019. Okay, Ravi Limited purchased goods at a cost of rupees 40 lakhs in October 2019. Till March 2020, 75% of this stock was sold. The company wants to disclose the closing stock at rupees 10 lakhs. The expected sale value is rupees 11 lakh. And a commission of 10% on sale is payable to the agent. What is the correct closing stock to be disclosed? Now 40 lakhs stock cost, 75% is sold. That means 30 lakhs is sold. So closing is how much? 10. I told you recorded at cost or at net realizable value, which is how much? 11 lakhs. Whichever is less. But here they have given me the expected sale value is rupees 11 lakhs and a commission at 10% on the sale is payable to this agent. So if my value I am taking 11 lakhs, okay, if I am trying to sell this particular stock at 11 lakhs, I have to pay a commission. So take 11 lakhs and take 10% of 11 lakhs. How much? 1,10,000. 11 lakhs into 10% will give you 1,10,000. Now from 11 lakhs subtract that 1,10,000. You will get 9,90,000. So your actual net realizable value is 9,90,000 and not 11. Which is the lower, 9,90,000 or 10? 9,90,000.
Like 9.
This question is asked even in this year, this attempt, June. And they are probable to ask this type of question again and again for inventory. Okay. We will see there is one more question similar with different numbers. Okay. Now IAS 2 provides for reversal of the write down inventories too. When you write down inventories, why do you write down? Whether you write down at cost, inventories only we are doing. Okay. We write at replacement cost, we write it off at net realizable value or net realizable value limited to the amount of the original write down. Okay. So we write it means this, they are giving it in the legal language term. But in the simple words, whenever you are writing the closing stock, the inventories, okay, you write it at the cost, actual cost which you have incurred or the net realizable value, whichever is less. Whichever is less. If you are taking the net realizable value, it will be limited to the amount of original write down. What is the amount of original write down? If there is any write down of happening of the inventories or writing of some inventories, okay, then to that extent only the net realizable value also you will take. You cannot go lower than that. Okay, here also I am taking what? Of 11 lakhs, 10% commission I am taking as an expense, because of which my value will get written off of my stock. I am taking it to the extent of 9,90,000. Okay, so when you see from the theoretical or language legal law point of view, net realizable value limited to the amount of the original write down. This is what is written in the standard. Okay. Dividend declared must be paid within 30 days of the declaration. As per IFRS, disclosure to be made only in consolidated financial statements of the parent company is of earning per share. We don't do that. We do earning per share for consolidated and for sole statements also. Now see this. X Limited purchased goods at a cost of rupees 60 lakhs in November. Till March 75% was sold. 60 into 75%, 45. Therefore closing stock is how much? 15 lakhs. Okay. The company wants to disclose the stock at rupees 15 lakhs. The expected sale value is rupees 16.5 lakhs realizable value sale value is 16.5 lakhs and the commission at 10% on sale value is payable to the agent. So if I am taking 16.5 lakhs and removing that 10% from that, 16,50,000 into 10%, which is 1,65,000. So actually my net realizable value will now be 14,85,000. So whichever is less, 14,85,000. Okay. AS7 issued by ICI deals with construction contracts. Again, auditor has to give his opinion as per section 143 subsection E. Okay. So this is it with your lesson number 10, accounting standards. It is important, whatever I have given here in my notes with this past exam questions, that is it what you have to do. Alright. Thank you so much.